Right, hello then everyone, as we are at the beginning of another week of trading on Monday the 29th of January, last week of the first month of the year, or last couple of days of the last month of the year, or the first month of the year, should I say. We'll start with GDP figures though. We'll have a look ahead towards the week, Tuesday, Wednesday, Thursday, Friday. Main economic data prints of this week. No high impact economic data to kick off the week on today. Anyway, we've got a raft of central banks out this week, or a couple of central banks, should I say, raft of high impact decisions. But Fed on Wednesday, we'll have a chat about. We'll have a chat about the BOE on Thursday, and we'll also have a little bit of a look at NFP on Friday, as it's the first Friday of the month. But GDP figures across the Eurozone out tomorrow morning. Now, I think, it's kind of, if you have a look back to last week, you see, European stocks, put on the 4 hour chart, it takes a minute to load, but European stocks have been rallying hard over the back end of January across the DAX, across the Euro stocks, which is a bit surprising. When you come around and have a look at this, Nate, these are flash estimates for Q4. So it's not a final figure by any stretch of the imagination. It is a flash figure. So it's kind of an estimate. The final figure will be thereabouts, the final the flash estimate, should I say. But the flash estimate, minus 0.1% in the previous month, and then minus 0.1% for the, I said month, minus 0.1% for Q3, minus 0.1% for Q4, which would be a technical recession in the Eurozone. Now, it's not exactly a deep recession, pretty shallow, although that does meet the technical terms for a recession if you do get 2 consecutive quarters of negative growth within an economy. Now, certainly the economy across the Eurozone is not performing well, but I think markets are more looking towards the fact that the ECB are going to be cutting interest rates at some point in the first half of this year. They seem to believe about a 90% chance that we will get that in April. Obviously, a technical recession does kind of bring that thought process kind of further to light. So we'll keep an eye on that tomorrow. Is it likely to move markets too much? I'm not so sure. If you do get a miss to the downside, it is a little bit deeper than markets first feared, well, then that is obviously something we will pay attention to. But it's certainly not the most important data prints of this week. Most important then comes on Wednesday, sorry, from the Fed. No changes in the interest rate. To expected. That's absolutely guaranteed. We are not going to get a change to the interest rate, but their rhetoric around interest rate cuts will be what we will keep an eye on. Now, at their last meeting back in December, they did say that the discussion on interest rate cuts had begun. 10 days prior to that, they said no discussions on interest rates had begun. So within those 10 days, they decided to change the narrative. I doubt they just decided within those 10 days, oh, maybe we'll start talking about cutting interest rates. So we'll have to see what they say for themselves on Wednesday. Now, economic data does continue to suggest that no interest rate cut is needed just yet. Markets had priced in kind of an 80% chance of a cut in March. That now sits somewhere around 50%. So there's less of a need for an interest rate cut in March. When do they cut is the question. Does it become kind of May, June sort of time? Let's see what they have to say to us. There's no economic projections, no dot plot, none of that. So we are literally just looking at their statement and then what Jerome Powell says at 7:30 during his press conference. My idea personally would be they will probably push back on March and have a look at the US dollar. If you come back, certainly over the month of January so far, you can see Aussie's lower, Kiwi's lower, Euro's lower. It's probably better if I put it on a daily chart, but you can see over the month of January, your Aussie's lower, Euro, Kiwi. Sterling's holding firm, a bit of underlying sterling strength, which we'll get onto in a minute. Dollar yen's popped higher, dollar Swiss has popped higher, dollar CAD's popped higher, and this is obviously then the dollar index as well. And there's a bit of an inverse head and shoulders on the dollar index, which does that set us up kind of technically for a bit of a move higher. I think certainly a pushback on interest rate cuts, and maybe even no clarification on when we do get a cut, may be likely to be supportive for US dollars this week. Last week we were looking at US dollars lower, which did kind of how we finished, albeit a bit choppy. This week, think about the ECB. The ECB will cut interest rates before the US, I think, and certainly when the US come out and push back on a March cut, maybe do they give us no definitive answer? Do they say don't expect one certainly in Q1, maybe even Q2 of this year. Really, we don't know. Ultimately, at the end of the day, they are likely to push back on a March cut, as there is no need for a March cut. They probably say they'll watch the incoming economic data, and the incoming economic data still is positive. 3.3% growth in the economy over the course of Q4, and then 4.5% over the course of Q3. That is not a situation where you need to cut interest rates. Consumer spending still remains positive, and that's propping up the health of the US economy. So let's see how that plays out on Wednesday. Yeah, I'd say they're probably likely to push back on interest rate cuts, which would lead me to suggest I think US dollars may be higher come the end of this week. Into the Bank of England then. Sterling has been strong over the course of this year. Okay, interest rates 5.2 versus 5.5 in the US, but that's not really what we're paying attention to. I think the Bank of England are going to be one of the last, if not the last, to raise interest rates. Inflation, certainly core inflation, is up at 5.1% year over year in the UK. That's not a situation where they can go and start cutting interest rates. Yeah, okay, the economy is performing poorly, but not so poorly where they have to cut interest rates due to that. The employment figures remain fine in the UK. People remain in jobs. There's no kind of unemployment rising by any sort of pace. Inflation's still too high. Both of those kind of components of their decision do suggest that they will probably not cut interest rates anytime soon. You've obviously got a bit kind of different data out of the UK. Members of the Monetary Policy Committee voted 3 to 9 to hike an interest rate, 6 to 9 to be unchanged. Market consensus is for 1 to 9 and 8 to 9. So that is more of a step towards being dovish, but I mean, keep that vote cut. I doubt any of them are going to really vote for a cut. I mean, they could well do, but I doubt any of them will, with inflation where it's at, with the labour market where it's at. I'm not really sure if cutting is the best thing to be talking about for the Bank of England. But again, I suppose we'll have to wait and see what they have to say for themselves on Thursday at 12 o'clock. But as I said, I think they're likely to be one of, if not the last central bank out of the major central banks to cut interest rates. That is why sterling has been supported over the course of this year. They have suggested that they have not started talking about interest rate cuts. That is premature. I think they're likely to reiterate that stance, and I think sterling, maybe not against the US dollar, but I think sterling probably set for a positive week across against the rest of the major currencies. Non-farm payrolls on Friday, unemployment rate on Friday from the US. Non-farm payroll slightly lower than the previous month, the unemployment rate slightly higher, but with the way economic data has been going in the US recently, would not surprise me at all if it missed consensus, or is that miss or beat on the unemployment rate? It's kind of backwards to the rest of the figures, but if it comes in below consensus, that's obviously a positive, and that is likely to see stocks continue to rally. I mean, yeah, they might push back on interest rate cuts, which may be a bit negative for stocks on Wednesday, but ultimately, if the unemployment rate comes in positive, that is likely to be a scenario where stocks enjoy themselves. So yeah, back end of last week, or certainly over the course of last week, stocks higher. They're making a slight attempt higher, albeit not any sort of aggressive pace, but US stocks trying to push higher again in today's session. Let's see how the US opens. Let's see how US opens at 2:30 today. But the S&P, the Dow Jones, the Nasdaq, all positive weeks last week, with the Russell global stock indexes all positive. Yields a little bit all over the place. Does look like a bit of a head and shoulder kind of thing in the 1 hour, but ultimately they've been sideways for a few weeks now. 2-year yield sideways, looking for the fresh direction. Do we get that from the Fed? We'll have to see on Wednesday. Oil continues its move higher, right? So oil pushes higher over the course of last week. Again, there's fresh concerns overnight with a missile hitting another oil tanker in the Red Sea. Again, conflicts in the Middle East continue to underpin oil prices. You then see the US economy continuing to outperform. That again is supportive for oil prices. So certainly from a pullbacks in the oil on oil, or dips in oil, I think should be bought certainly for now. The US dollar, as we spoke about a little bit earlier, we're pretty sideways over the course of last week. You can see a really tight range on the Aussie, tight range on the Kiwi, Euro dollar, cable a bit all over the place, dollar yen, relatively tight range. So not too much to see last week over the on the US dollar, should I say. Does that push higher into next week, or into this week? Sorry. That wouldn't really surprise me too much. But no economic data for today. We'll be back tomorrow and the rest of the week for further updates on all of this. Let's see how that pans out over the course of this week. But best of luck trading. Just look in the markets, see what you can find, and we will update as and when we get to it throughout the rest of this week.